These files were never meant to be public, but someone reopened them. This is the Dark Bureau. Far from government centres, several hundred miles off major coasts, lies an archipelago of islands presented to outsiders as pristine paradise. But the true action happens in the paperwork, not the beaches. On these islands, addresses house thousands of corporations. Blank offices double as global HQs, moving billions every week. While the coves seem untouched, legal abstractions here support the world's hidden money flows, quick changes of ownership, sudden rerouting of profits, all protected by layers of secrecy. The calm surface is misleading. Beneath lies an invisible financial hub, built from legal codes and digital signatures rather than buildings and labour. Tourists search for dolphins or coral, but within the facades of vacation rentals and impersonal reception desks, a complex engine runs. Law firms orchestrate secrecy schemes at high speed, registering new companies by the hour. A simple digital form can launch assets into a world almost impossible for authorities to follow. Why did remote islands become the centre for global money movement? The answer: decades of deliberate legal engineering to create a parallel economy governed by privacy, specialised laws, and strategic distance. Here, property is not just physical, it's a vehicle for untouchable wealth. Jurisdictions shift. Cayman Islands, British Virgin Islands, Navis. But their selling points are consistent: near zero taxation, nominee directors, and reliable courts that shield information from foreign requests. The islands are dotted with lawyers and accountants offering confidential services that turn an address into a shield from investigation or tax. For island governments, this industry is lucrative. Jobs, revenue, influence from businesses with little visible footprint. For clients, once only the ultra-wealthy, now including corporations, investors, even startups, the deal is clear. Pay the fee, and your assets are insulated from prying eyes, lawsuits, and regulation. The private island finance business is no accident. It's the result of intentional design, shaped by the influential and those who build the world's financial machinery. From inside, offshore work seems routine: forms, signatures, company seals. Intermediaries, often knowing little about who truly benefits, push documents through convoluted chains of ownership, with nominee directors signing wherever needed. A villa, barely inhabited, could hold legal title to a shipping fleet or an entire telecom infrastructure. Governments lose out. Revenues and transparency vanish as trusts multiply, and requests for information grind to a halt behind offshore barriers. Each local loophole is marketed by resident professionals who sell new structures as fast as outsiders can regulate. All is kept technically legal, documents stamped and compliant, but the net result for governments is vast. Hundreds of billions in lost potential revenue slip through this legal maze every year. This system flourishes through a blend of legal savvy, local politics, and international inertia. Island governments anchor their economies to serving offshore clients. Regulatory gaps and lack of global coordination allow the network to adapt and expand. If one island faces blacklisting, competing ones pivot their offers, updating procedures just enough to claim compliance while preserving secrecy. Fragmented oversight, underfunded regulators, and a local culture protecting secrecy as survival make oversight nearly impossible. The system's true workings were thrust into the open in 2016, when the Panama Papers leaked over 11 million documents, revealing how politicians, CEOs, celebrities, and even criminals spun webs of trusts and anonymous companies. The reaction spanned public outrage, government pledges, and frantic efforts within the secrecy industry to adapt. As some jurisdictions face scrutiny, others gain new business, promising improved privacy to attract transferred assets. European efforts to blacklist non-cooperative havens prompted jurisdictions to tweak practices just enough for formal compliance, all widely publicised. Nonetheless, real resistance to structural change was strong. Incentives for secrecy persisted, enforcement fractured, and each investigative trail exposed only how quickly the system evolved. New loopholes were devised and packaged for eager clients each time regulators pushed back. Policymakers developed templates for data sharing and beneficial ownership registries, but major companies sidestepped these by shifting profits through offshore subsidiaries. Economies depended on confidentiality as their main export lobbied for loopholes, narrowing definitions of compliance. Advisory firms flourished, guiding clients through new legal terrain, marketing risk mitigation as innovation. Each reform cycle built new resistance coalitions, bankers, lawyers, officials, championing secrecy as a sovereign right and growth strategy. Global consequences are sweeping. Luxury properties in cities from London to New York are secretly owned by offshore companies, often later exposed as tied to sanctioned regimes or the suspiciously wealthy. Opaque ownership hinders tax collection, property management, and law enforcement. Funds that started in autocratic states may pass through island banks, be invested in legitimate enterprises, and return to the world cleaned of identifiers. Western real estate becomes a magnet for capital flight, with anonymity not only tolerated but promoted. For governments, revenue lost to secrecy is enormous, enough to transform infrastructures, fund schools, or expand healthcare. Residents on the islands themselves may see shiny offices and luxury homes rise, but most of the population benefits only indirectly, facing higher costs of living and lingering social divides as financial secrecy becomes embedded in national identity. The system grows ever more complex. Automated software now forms, layers, and migrates shell companies in real time, tracking compliance only at the surface. Compliance teams are often understaffed and unable to challenge dubious clients meaningfully. Regulatory arbitrage becomes the product, a service for sale. Each outside audit prompts repackaged service offerings, enhanced privacy, updated trust structures, or new layers of client anonymity. A culture of intentional opacity, institutional passivity, and high-level legal craft creates a sturdy architecture for evasion. The edge is not in hiding, but choosing which law or regulator applies, and when. Once the barriers between legitimate structures and illicit ones dissolve, risks multiply. State actors, organised crime, and major corporations all use identical routes, payment wires, legal wrappers, nominee signings, making it almost impossible to distinguish clean from dirty money outside rare leaks or insiders. Recent investigations show election finance, arms deals, and sanctioned accounts moving through the same corridors as legitimate business. Secrecy is more than a tax debate. It enables market distortion, undermines governance, and erodes states' ability to respond to crisis. Agencies designed for oversight hit bureaucratic dead ends, unable to pierce international barriers or adapt as rapidly as the industry mutates. For local economies dependent on offshore work, there is little political will for real reform. A built-in vulnerability. Technology continues to accelerate secrecy. Databases now process millions of real-time registrations, asset transfers, and trust updates with relentless efficiency. Compliance blurs into marketing. Secrecy itself is pitched as a value, a safe haven against future legal and political shocks. Behind layers of digital protection, profits are split and assets change hands invisibly, with minimal scrutiny traded for short-term gain. For the wider world, the effects are profound. Real assets, apartment blocks, shipping lines, trade hands through hidden ownership. City authorities lose out on tax, regulation, and planning, as critical properties are disconnected from visible stakeholders. At the national level, Public services face cuts even as island economies record surpluses far outpacing their size. Whistleblowers and journalists trying to trace ownership face threats, intimidation, and legal action, their work increasingly difficult and dangerous as the secrecy industry pushes back. As regulators adapt, so do the players. Crypto financiers run digital assets through offshore nodes. Climate investors buy land with layered trusts, sidestepping new carbon market rules. Political donors and even rogue states tap the same machinery. Regulatory bodies forever lag behind. Even after major leaks and some policy wins, structural reform is slow and outpaced by the rapid innovation of secrecy providers. For island economies, secrecy is simply too lucrative, not just in revenues but also in jobs and political capital. Societies on the losing side grapple with rising inequality and shrinking public services as the roots of global wealth disparity deepen. Reform is elusive. Each closed loophole is replaced by new consulting services and adapted legal or software tactics. On the islands, guarded compounds and luxury marinas grow, while local residents struggle with housing or price surges from absentee, anonymous owners. Even asking who really owns property or a company becomes fraught, with answers carefully managed and, in many places, risks for those who inquire. The offshore machine races forward, evolving with each wave of investigation or patch of regulation. Each leak or reform remakes the landscape, but rarely answers the central question: will the world ever shine genuine light on the deepest flows of invisible capital? Can private islands remain safe harbours, or will collective action force accountability? As secrecy and oversight collide, the full costs remain unknown. Each year, the stakes only grow.